Sure, let's go ahead and get started.
Great. Good morning, everyone. How are you? I'm Anand Radhakrishnan, and I'm going to be moderating this panel on the institutional adoption of crypto. I'm Mark. Thank you for setting me up with the question you had asked earlier to Joe Lubin, but that's hopefully what we're going to have the discussion on today. A couple of housekeeping notes before we go into just introductions in the panel. First is that I will be asking the audience for questions at the end, so please think through what your questions are going to be, so we can have more of an interactive conversation. Secondly, the session is being recorded, so we ask that you don't record it yourself. If you are tweeting on social media or anything like that, the hashtag is BCVC Summit. But we ask that you observe Chatham House rules, meaning that you can kind of talk about the event, but please don't attribute anything specifically to any one of the panelists, just so that we can have a candid and fun conversation today. So with that, I will start with a quick introduction of myself. I am a managing director at a firm called Investcorp. We are a large global alternative asset manager with over $40 billion of assets under management. My experience is in venture capital and private equity, and I've been there for over 20 years, but have been investing as an institutional investor for over 25. And I also am managing director of a joint venture with United Talent Agency in Los Angeles, focused on investing at the intersection of Web3, the creator economy, and the future of entertainment. And then I'm going to let each of the panelists just do kind of 30-second introductions, and then we can kind of get started with the conversation. So I'm going to turn over to Tracy first to talk.
Great. Hi. Tracy Fong here, partner at Albourne. Albourne is an alternative investment advisor, investment consultant. We have 300 institutional clients, $650 billion of alternatives under advisory, and we've had a breadth of crypto, digital assets coverage for quite some time. My background is I started in Web 1.0 in the late 90s, turned over to Web 2.0 at Yahoo in corporate venture capital, and started my Web 3.0 journey in 2014, 2015. Thank you.
Hi, everyone. Let's see here. Can you hear me?
No?
Oh, that worked.
Try it again? Yeah. Okay. Glad to be here today. I'm Lauren Abendschein. I look after the Americas institutional sales team at Coinbase. Coinbase, of course, largest publicly listed company in crypto, have been operating since 2012 across retail, institutional, as well as cloud businesses. And looking forward to the conversation today.
And Marcos?
Hi, everyone. This is Marcos Veremis. I'm a partner at Accolade Partners. We're a large fund of funds, venture capital fund of funds in Washington, D.C. We manage around $5 billion in assets, of which $1 billion is in blockchain-related strategies. And I started my journey at Cambridge Associates, where I started my journey to Web3 at Cambridge Associates back in 2017-18, when I started kind of formally looking at the space on their behalf.
That's great. Thank you so much. Sam, the timer is not on, so someone will just have to make sure that I'm on time. Otherwise, I'm going to keep. I don't know if anyone heard. Sam, the timer is not on, so I just want to make sure that goes on in case, because I will just keep talking. But so actually, we had a whole thing prepared to talk about institutional use of crypto, and obviously, given that we've got 3 institutions here on the panel who are into crypto, and this is what they do for a living, I know where they fall on the side of, should we be investing in crypto or not. But I would be remiss if we actually went down that path without addressing the dumpster fire that was discussed earlier that's going on right now in the space between FTX and Binance, which, by the way, as of this morning, Binance has now said they're backing out of the deal, which is kind of the latest news off the press. So really, the question is, the difference between some of these other things we've seen in the past, in my view, from a Voyager or a Celsius, which of all, this is part of what's going on just in the space, that there's a bit of, the lack of maturity in the space is, resulting in some of these blow-ups. But FTX really is different in the sense that, the brand name is really out there. Whether it's arenas that they've got named for them, or Giselle out there talking about FTX. It's really in another category that this is really getting everyone's attention. And if you go back to Kate's point about trust and the idea of what this means for institutions who are actually looking to engage in trust ultimately with their ultimate investors. How does this fact change kind of the narrative or the discussion that we're having kind of as institutions as we come and make the case that crypto adoption should be kind of front and center? So who would like to start with that?
Well, I'm happy to jump in there to start. So I think there are a couple of things that institutions need to understand from the outset in this conversation, which is, first of all, when you're looking at crypto and sort of the future of the industry, recognizing the myriad use cases in this space and the way in which decentralization plays a really critical role in enabling these important use cases is really key here. And I want to make sure that folks in the audience understand there's a critical difference between CeFi institutions, of which, by the way, Coinbase runs a number of CeFi, an exchange, a prime broker, retail access, and DeFi applications. What I think is concerning here from a trust perspective is you start to really conflate those two, which is an instance of an un or under-regulated CeFi group attracting investors and activity offshore in many ways because of a fragmented regulatory system here onshore. That is a very separate thing from what's happening in DeFi, from what's happening at the builder and developer level in this space, which is really important. And so I hope that, as we sort of navigate this, this latest disruption, we keep front and center that important distinction. And then back to my second point, this is a moment to really focus in on regulation as well. And Coinbase has built our business from the start to comply with regulations, to be regulatory forward, to partner with regulators. And we do think that regulatory clarity is just of critical importance at this time. Also, I would be remiss not to just comment, for the group, and as we've posted publicly on this, and our CEO has highlighted, we do not have exposure to Alameda or material exposure at all, sort of across this, FTX, FTT, et cetera. And we think it's just very important, again, to highlight, compliance and consumer protections at this time.
That's really profound. That's responsible of Coinbase, of course. Lauren and Coinbase have been long-term partners to Albourne in this Web3 journey. I think to underscore some of what Lauren has said, what we often do with respect to underwriting managers, and just for context, I've spoken to 140 crypto VC fund managers, 20 of the generalists, and many of the broader market, some of whom I see in the audience here. In any case, and in that context, one of the things that we find extremely important are two primary concepts. One is really digging into the market structure, and two is the integration between operational due diligence and investment due diligence. On the market structure front, for your perspective, I'm sort of a student, like all of us, of the numerous cycles that we've gone through, the technology boom and bust, in my case in Web 1.0, and the global financial crisis, and some of the fallout from that. When I worked at the Harvard University Endowment, we, about 10% of our look-through exposure ended up being exposed to the Brazilian real. And so an extremely volatile underlying asset. And what we often recommend to our institutional investors is to really understand the multiple layers of look-through through to, I'd say, abstract concepts, just as Lauren said, in terms of what are the look-through considerations with respect to custodial and other relationships that are underregulated, if you will. If you turn to the other considerations with respect to operational due diligence, I think that we, as allocators, just as Joe had said, have also suffered a little bit of irrational exuberance and have stepped back and really, as part of the integration between operational and investment due diligence, really looked through to some of these organizations, their underlying mafias, if you will. As you know, there's the Tiger Club mafias, the PayPal mafias of the world, and there's also a Web3 set of mafias, and the integrated perspectives, relationships, capital commitments associated with that, background checks, compliance, through to custodial relationships, through to valuations, and that has a long tail of considerations.
Yeah, and as an institutional investor, I mean, ODD is something that everyone does. To be fair, in the FTX case, I mean, you do have some pretty sophisticated investors in there. I mean, you have an Ontario Teachers, you have a Sequoia. What do you think happened there? I mean, as someone who comes from this sort of ODD area, did they just sort of ignore it? Is it just the lack of maturity and people? Was it exuberance? Do you have a view?
I'm happy to.
Go
ahead. Go ahead,
please, Marcos.
So, yeah, I'm happy to take this because we are now kind of in the middle of all of this, right? We're speaking with our managers, and one thing I can say is that at least from our part at Accolade, the 15 or so core relationships that we have with managers, we've avoided the centralized financial participants like Celsius, FTX, both from an investment perspective. We had almost zero to actually zero in most of our funds. To the operation side, we don't have any assets caught up into this. I think so. We have been lucky. Now, with that said, your question is, how did some of these sophisticated investors like Sequoia get caught up into this? And I don't have the answer for you. I feel that I would have thought that they had a full kind of perspective on the balance sheet of FTX, full transparency there. I'm not sure what FTX shared and what they didn't share. So I'm not in a position to tell you exactly where their due diligence failed in this respect, if it did. But all I can say is that the managers, and I think Lauren touched upon this, that primarily focus, the managers that we love and invest in, primarily focus in this space because of its decentralized nature and the applications that can enable. And that includes decentralized finance, very heavy presence there, NFTs, etc. So this whole kind of centralized, opaque component has been absent. The other thing that I should say is, nonetheless, in my opinion, and I'm not going to sugarcoat it here, what happened yesterday is going to hurt institutional flows into the space, because many people think that FTX or SBF are synonymous with crypto. They're not, actually, but many people think so because of all the publicity, the endorsements, the stadiums, the politics, etc. So we will need some time to recover from this as an industry, I think, in terms of perceptions. But longer term, my view is that flushing out all these opaque bad actors, in my view, it's good for the space long term. But short term, there will be pain.
Do you agree with that?
Yeah, I do think that's fair. And it would be hard to say otherwise, right? Given the magnitude of publicity here. But I couldn't agree more that long term, the continued focus again on the elevation of builders and businesses that are running in an upstanding and a transparent way is of critical importance, more now than ever. And I think this just continues to sort of push momentum in that direction, to say whether it's regulation, whether it's more things on chain, whether it's again sort of a deeper focus on ensuring transparency in the investment process and in partnering with different businesses or actors in the space. That focus is really, really important, and I think that's what really moves the industry forward.
That's right. I think in that vein, it feels as though, across most vectors of the related economy, this market opportunity has really crossed the chasm, whether it's entertainment and media, like in the case of your collaboration, and love to hear more, in the case through NFTs, metaverse, et cetera, through technology, traditional large-scale technology companies like Facebook, now Meta, in the context of metaverse, through to some financial institutions of importance. As someone cited earlier, Mark cited earlier, the relationship between Circle, Paxos, and JP Morgan, pulling through some really critical, I think, further positive branding in the ecosystem and the market opportunity thereafter.
So it sounds like, first of all, I'm assuming that none of you are sort of rattled by this FTX just based on the comments that you guys made, but you obviously are saying that it will have an impact on the institutional space. So to me, I guess it sounds like, is it more almost a rebranding and a focus on, I think a lot of people are kind of conflating DeFi with Ponzi schemes at this point. Certainly that's the word that's going out in the press today on FTX. Is it really changing the narrative to talk about the actual use cases that are out there? Is that what we should be focused on?
I think in many ways that's been the focus all along, and I've been in this space, since 2018, which is early for some and late for others, but this sort of answering the same question, and rightfully so, what are the use cases for this space? Again, I think that conversation is important now more than ever. And Tracy, you just alluded to some great examples, but we're at a time where we have Fortune 500 companies that are finding new ways to innovate on modernizing their IP, or finding new ways to engage with customers through NFTs as a design space. We have companies looking at payment systems using USDC or other stable coins in order to minimize risk and modernize operations. I mean, there are use cases abound, more so by the day, that I think it really is incredibly important for us to focus in on. And that's really what spurs the ongoing institutional adoption here. And I think what becomes difficult is just, again, that conflation. I think you're right, and it's hard for people to parse through what is DeFi, what is CeFi, what is unregulated CeFi, and the sort of differences there, and how that gets impacted, which is why I would just keep sort of pointing folks back to understanding, what is the exposure that you're really referring to when you're concerned about these issues, and just education remains, I think, at the forefront in that conversation.
Marcos, do you want to add
totally agree, by the way, to what Lauren said, and you'll see even in press articles there's a conflation between decentralized finance, centralized finance. I think these concepts are not clear. I remember there was a Wall Street Journal article back, I think, when Celsius and the Voyager went under, talking about how DeFi has failed. Just in the Wall Street Journal, actually, it was the exact opposite. It means these were centralized entities, right? So I think there needs a lot more education and debate, and maybe rebranding, as you said.
So let's actually parse this out a little bit, because I think one of the promises of Web3 and where we're going with this is true decentralization, right? And what kind of is hard for me to kind of get my arms around is, are we going to truly get to that promise? Is at the end of the day, is it going to be partially decentralized and you're still going to have a need for centralized intermediaries? I mean, ironically, we just talked to Joe Lubin at Consensus, where, in theory, promoting a very open ecosystem, which of course they are, but Consensus actually kind of is the 800-pound gorilla in the space that's not supposed to have 800-pound gorillas, right? So, how do you actually see this kind of playing out, and where do you think the world is going to go, just at a high level on this? Who wants to go?
Well, I think it's a very good question, and one that's really exciting to us. Honestly, I would recommend to anybody to listen to. There's a really actually great podcast that Brian Armstrong, our CEO, did on Bankless. It's actually about a year ago now, but he really got pressed on sort of is Coinbase trying to become the JP Morgan of the future? Are we just trying to centralize everything? And I thought he had, some really great insights on how we can look to better integrate, decentralization and ownership, things like decentralized identity, into our core products, and become, in many ways, a facilitation of that sort of access. And a good example would be, Coinbase launched our DApp wallet right out of retail. So in the Coinbase Blue app, you can access DeFi applications in a DApp browser. And so we see, that migration through safe and trusted hands into a more decentralized world. It's not going to just happen. It's not a binary thing that happens overnight. I think we have to adjust and evolve through trusted and more sort of initially centralized means into a more decentralized world.
Yeah, I would. Oh, Should I say? Yeah, I would say there will definitely be centralization in many respects. I mean, Coinbase is centralized, right? But it's a centralized entity that is transparent, that is managed in a very professional way. I think there will be obviously centralized services around the blockchains, the open permissionless blockchains. But I think that what we need there is full transparency and good actors, right? And like in every business. And some are more systemically important or systemically like dangerous, I would say, not important, such as exchanges, rather than an interface, for example, connecting you to a DeFi protocol. So there are also layers kind of centralized entities and risks around them. But I think one thing that is probably over at this point, or should be over, is completely non-transparent entities managing large amounts of money.
Yeah, absolutely. Switching gears a little bit, because we have at least two of you are real allocators in the space, and I'm sure people are kind of interested into how, maybe the mindset of how institutions are thinking about allocating. Maybe you can share, Tracy, why don't we start with you, just some of your experience in terms of what you're telling your clients in terms of how to look at the space, how to think about it, and sort of the areas you're steering them through and the things that you like and don't like about that.
Sure. I think, one of the ways that we've steered clients to look at the space is like any nascent asset class. So I think one analog to that would be the rise of natural resources, real assets as an asset class. And in that context, you have, early opportunities to expose yourself. I remember at Harvard, for example, we had a 2% exposure to just generalized commodities. So we had a swap exposure into the Dow Jones, UBS, and GSCI indices. Turns out they were overweighted to oil and gas in a lot of cases, and were just plain vanilla derivatives exposures. But as you move up the value chain as it relates to beta through to alpha, you had more hedge fund commodities traders deriving alpha from some of these underlying commodities exposures through to holding some of the underlying assets. And this was sort of early in the 2000s era, holding oil and gas assets, oil and gas midstream assets, holding timber and agriculture assets, through to ultimately external managers driving alpha in this space. And I think that there are certainly some analogs in the crypto space as it relates to holding Bitcoin and Ethereum outright, or certainly with a qualified custodian like Coinbase and others, holding and then participating with hedge funds in a lot of cases. Most of our hedge fund, what we've surveyed across our hedge fund exposures is over 50% of macro funds have exposure to cryptocurrencies in some capacity. It'll be an underlying trading paradigm within the hedge fund space, through to DeFi or yield farming being a replacement for high yield in some cases, and then finally venture capital, crypto, an opportunity for growth investments. While there were some tactical plays into crypto, like in 2020, where people were playing the inflation trade, I think that a more steady state approach would be a diversified approach to the various asset classes as described.
Marcos, do you want to share from your standpoint as an allocator?
I'm sorry, I couldn't hear you. There's my signal is a little off, but can you ask me the question again? Sorry.
Sure. As someone who's kind of has the institutional allocator's viewpoint, what you're telling your clients, what you're telling your, how are you evaluating what to invest in? Where should we be focused? Where shouldn't we be focused from sort of your perspective?
Yeah, sure. So we have a very clear kind of strategy into how we invest. We invest in on the venture side of things. Meaning we don't do trading strategies, we don't do arbitrage strategies, etc. So all our investments come from the venture perspective. We're generally focused more early stage. That doesn't mean we don't own tokens. We own quite a few, and especially after a while when things launch. But what we're trying to do here is we want to be concentrated. We want to have 15, 16 funds. We want to be very selective into kind of how we underwrite things. So if we're going to add a new fund, we need to think of it as a replacement for an existing fund. That imposes certain discipline. From a portfolio construction perspective, we do both generalists, but we've also done specialists. And I think in the crypto space now, you have the emergence of specializations. There are funds that are, very native to DeFi. There are funds that are very native to the creator economy or NFTs. And even now we're seeing funds that are even more kind of niche in their areas. Like we met with a decentralized wireless, for example, fund. So what we are trying to do is we want to be smart about being allocated towards the main areas and also adding a degree of specialization where we can, especially at the early stages, right? Where some of these funds can really focus on kind of gain an edge. So we are investing in all major categories, if in layer ones, DeFi, NFTs, etc. But we have an open mind with respect to how this space is going to evolve also, right? I mean, in 2-3 years, we might be talking about completely different categories. So we're not targeting a certain area, if you will. We're trying to invest with the best people.
And I'd be curious because you do more early stage. Is there a crypto winner at all at the early stage?
That's a great question. The deal flow is still pretty strong at the early stage from what we're hearing. I mean, valuations have gone down. I mean, in certain cases, seed, pre-seed, you've seen valuations go down 25, 50%. So there's definitely a reset. But with that said, deal flow is still pretty strong up until now in this winter. There's a lot of startup activity. There's no feeling of a freeze at this point in any sort of way. Managers are just a little more slow in calling capital and funding investments. But I think the Web2 talent that got in and the developers that got in through the last bull market are still there from what we're hearing. Now, we can talk in 6 months, 12 months to see how this plays out. But I think that my base case is that compared to 2018, where there was a real worry that people were going to leave the space, I think this time this is not going to happen. I think the space has gone too far.
And a lot of that is due to the fact that institutions have pretty much come in this time, right? I mean, that's kind of the undercurrent of this, correct?
That's right. Yeah. One of my observations too, I split my time between San Francisco, where I've spent through to the late 90s, or from the late 90s, and here in Seattle. And so I think some of what I've been seeing with, as Marcos has pointed out, the Web 2.0 builders has been profound. And, there's a really important follower effect across high-profile founders that create interesting opportunities in Web3. If you think about Aptos coming from some of the Facebook ecosystem, for example, and many, many others in the space. Here in Seattle, a number of gaming, Web1, Web2 gaming executives have come out to develop on Web3. And I think that is a consistent attribute of crossing the chasm, if you will. I think one other thing that de-risks the opportunity for, as you said, the institutionals are coming, whether it's institutional builders or institutional investors. One other thing that has really de-risked the opportunity set is a lot of the developer tools that have been built out and the platforms for which you can build from, just as you heard from Joe earlier today. So I know about 50% of the audience here are builders, and so hopefully it gives you continued confidence that one, there are peers in the ecosystem, developer tools and other ecosystem and infrastructure tools that can support your long journey, and then institutional capital behind that.
Yeah, Tracy, I think that is such an important observation too. Even just thinking about if you're a developer coming in and looking at those tools, being able to not have to build your own node to interact, to query and transact with the blockchain, be able to just, get that off the shelf as you would say, go into AWS and, getting access to, full suite of tools. I think that has fundamentally transformed, in the last few years, enabling builders in fundamentally new ways. And, the fast evolution of underlying blockchains. I mean, we saw Ethereum, and let's not forget, these sort of incredible things that have happened. We saw the merge go through, making Ethereum more scalable, safer, and building, a really important evolution for that chain. So many other examples of that. So it's really exciting to see how much easier it is to be a developer in this space. And I couldn't agree with you more in terms of institutional capital coming in as well, both institutional investors as well as investment directly in these chains.
Well, I know I'm conscious of time, and I want to make sure that we do get some questions from the audience, because like I said, I could just keep going because I love having these conversations with our panelists. But I challenged you in the beginning. Hopefully, you've been thinking of some questions. So, who has a microphone? Okay.
Can I have one of them? Apologies. Thank you.
Who has the first question?
I see a hand up.
Okay.
Here. Yep.
So this is a question mostly for Lauren. Sorry. So I saw in the past 24 hours, Brian Armstrong and I think Jeremy Allaire at Circle, made statements on how they're using customer deposits, and they're great statements, but they imply trusting Brian, trusting Coinbase, trusting Circle. Are there any plans to decentralize and provide that cryptographic truth through a proof of reserve function or something where you're kind of opening up the auditing of user deposits and making that data public so that you don't have to trust, you can just guarantee?
Yeah, I think that notion of proof of reserves is a really interesting one, sort of broadly in the space, and it goes back to that focus on transparency that we think is really important. As a public company, though, we do have public financials, publicly audited financials. You can look at our, the customer deposits on our balance sheet and see that they are backed one for one. And so, we have that CFI trust, by virtue of our regulation and our public statements. We think that goes quite a long way. As far as the sort of broader, transparency proof of reserves, that is definitely an interesting question, but not one that we have a specific response on at this point.
Sure, thank you.
Who's next? Over here.
Political question. How do you think the Chinese Communist Party plans to stop this kind of freedom of information?
Who would like to take that?
I'm happy to take a shot at it. It's but when we say freedom of information, to stop the freedom of information in what sense? To stop blockchains, to stop crypto. Maybe I'll talk about that. I don't think any centralized country or entity can stop this technology. Very simply because it's reliant on public blockchains like Bitcoin and Ethereum, with hundreds of thousands of nodes spread across the world. I remember when they were saying that the Chinese could take over Bitcoin because all the miners were there. Well, guess what? The miners left. They're in the States now, and Bitcoin is still functioning. I think this technology, if anything, is the most resilient in my mind of any technology ever invented to censorship, centralization, and restriction. So, I'll stop there if there are any more questions.
You have it there? Okay.
One of the Balaji Srinivasan, who formerly came from Coinbase, he has a theory that the broader ecosystems or political economies might break up into three primary categories. One would be more of a communist network state. One would be a Western state, so the Western economies that we're accustomed to today. And then the third would be a crypto economy and network state based on cloud cities. He has a book out that you might consider reading that emphasizes that thesis.
Great. I think we still have time for another question. Over here.
Yeah. So I'm curious what your thought is with respect to the dangers of decentralization. One of the most interesting things, if you read say Investopedia about bear raids, the first thing it says is they're illegal and they're illegal because of the collusion. Once you decentralize, how do you account for that? Right? How do you prevent sort of internet mob rule when it comes to trading?
I know we kind of sort of talked about this a little bit, this concept of are we truly going to be decentralized or are we going to be centralized? I think the general consensus here is it's going to be a hybrid, right?
Yeah, and this isn't going to happen overnight. Is I think the biggest and what does decentralized mean? It's not sort of a monolithic concept. I think that it does, to my comments earlier, sort of as this space evolves and moves, hopefully closer, to finding opportunities for more decentralization, we have opportunities for discourse. A good example would be, so many of the projects that launch today have governance built into them, right? And so you can have DAOs, decentralized autonomous organizations, which is, the acronym, allowing token holders to vote and have input, across a number of important, considerations that are raised by the network. So I think there's going to be an evolution here, and it is a really exciting design space in some ways to promote more transparency and less collusion. And I think we should, be finding ways to move to sort of, process that thoughtfully.
Great, Sam, Kate, do we have time for another question? We do? Okay, great.
This is a question for Lauren. I know, Tracy, you mentioned that you felt that 50% of macro funds had some exposure to crypto or digital assets. How long do you think before the adoption of, let's say, the top 100 hedge funds and asset managers also put an allocation into crypto? And as a follow-up, do you think it'll be used as a trading tool or more of a buy and hold tool?
We highlighted in our shareholder letter last week that 25 of the top 100 hedge funds had onboarded to Coinbase, and so it was a good indication there. We do see very significant take up from the hedge fund community, asset managers as well. Of course, we also announced our partnership with BlackRock, enabling their Aladdin clients to be able to access Coinbase's Prime custody and trading tools. So there is clear momentum, and we can see that sort of in these public examples. Tracy, I'd love your input on where you think this is headed as well.
Sure. It sort of kind of it goes back to what I was suggesting about the analog to natural resources, real assets as an asset class. Some people might want long-only exposure to Bitcoin, Ethereum, other layer ones, layer twos, et cetera, kind of outright exposures to cryptocurrencies and those assets that you can hold outright. Increasingly, our family office clients and other sophisticated LPs are holding direct exposures to equity or tokens of earlier stage opportunities. And I think that the view from the broader ecosystem is that there will be some duality. The traditional asset classes like hedge funds that play the market across long only through to hedged strategies, but also just as we observed in the proliferation of the super angels within venture capital, we think that I think that I can't attribute this to Albourne, but I think that there will be an ecosystem built out where crypto native individuals will create their own hedge funds and hedge trading strategies. We see that a lot with proprietary trading firms having formed out of the last two cycles, and participants in DeFi, of course, being their own trading, hedge fund trading strategies through to super angels within crypto. So I think that there's going to be a large complexion of the evolution of the space, and decentralization of this decentralized space, if you will.
Yeah, and Marcos, I'd love to kind of once again get that venture capital kind of perspective as well, because obviously institutions put money into venture, and this is now a big area there. Would you kind of agree with that sentiment?
Definitely. I mean, again, I do follow closely the hedge fund side, and just to be clear, and know kind of how the share kind of crypto in the portfolios of all these macro funds and hedge funds has increased. One thing I can say on the venture side is this industry, like if I have to make a comparison, like this industry versus when I started in 2018, is so very different. I mean, it has progressed immensely. Back in 2018, there was a tiny portion of institutional capital into venture on the crypto side. Now you have billions and billions of dollars and more institutions coming into the space and trying to access it and have exposure. And I think this will continue. I'm sorry, with bumps in the road like the SBF situation today. But in the grand scheme of things, I think these are going to be bumps in the road.
I just kind of last question that I kind of wanted to ask you guys was sort of on, if we think of the internet evolution and we kind of compare that to sort of the Web3 evolution, there's lots of things that are similar, a lot of things that are different. But if I had to pin you down, do you think we're in like 1996, 2000, 2002, kind of in that sort of evolution? Where do we think we are in that? If it's a fair question, may not be a fair question, but love to.
Oh, yeah. Approximating. I have an experience from my corporate venture experience at Yahoo. In 2005, we invested in Alibaba for $1 billion for a 40% stake, which valued the company a little in excess of $2 billion in 2005. This was before the Olympics in China, before tier one cities were really a thing in China, and the large scale development out of the China internet ecosystem. And I think that Yahoo was considered a little crazy for doing that, and trying to get as large of a stake as possible. We were prohibited to exceed 50%, so we landed at 40. So it was a really interesting and harrowing time for us to consider something as convicted as that in a new space. And I think that that's one of the closest analogs I can bring to where we are today. Fast forward on that Alibaba exposure. In 2014, they went public. 2015, the MSCI finally adopted them, which resulted in $70 billion of incremental institutional flows. And I think that was an interesting period for which value accrual at a value of $250 billion market cap really took place over the course of those 10 years. And I think that's an interesting analog to where we might be today in terms of, 2005 is similar to 2022 in terms of an emergent geography, China internet, through to what we're calling metaverse and Web3. So it'll be really interesting. And, if you fast forward 10 years from here, what will the market structure look like? What will be the MSCI EM equivalent adoption to bring further capital flows? And I think it's quite important for institutional investors as well as builders to consider where we are today and the value accrual that one can participate in.
Yeah, I mean, I think we have to be sort of, late 90s, early 2000s, just maybe from a builder perspective. If we think about, we're still calling blockchain companies. Back then we were calling internet companies. If we fast forward to the future, that's not going to be a meaningful distinction for blockchain in the same way it isn't meaningful today for internet companies. But we're early days in that journey. I think what's notable here is just how fast we've accelerated through that adoption curve, and it makes me optimistic for where we're headed.
Marcos?
I have to agree with Lauren on the timing. I think it does feel like 99, 2000. You have so many applications, so many businesses, many of which are not going to work because they are kind of the first iteration. With that said, and we also have a winter, by the way, now. With that said, I don't think this space is going to be as slow as the internet developed, in the sense that bandwidth, for example, took some time. This was a physical network. Now this is all software. It moves very fast. People iterate very fast. They change business models very fast. It's capital efficient. So I think that we are probably in the 99, 2000 period, but not to scare anyone off, I don't think it will take 7 years until we get back to where we were before. That's my best guess.
I love ending on an optimistic note. So not take 7 years, but yeah, but it is a bit of an unfair question. If you ask me, I think we're like 95 for infrastructure is concerned, but probably 2001, 2002 as far as the opportunity for the next generation of people to build things. So thank you. So I could keep going on forever, but thank you so much to Tracy, Lauren, and Marcos, our distinguished panelists. Thank you so much, Kate and Sam, for inviting me to do this, and hope you found that interesting.
Thank you.